again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us for Market Insights and Observations. This is our Thursday, February 9th edition, and we're going to talk about three topics markets are paying attention to as we are and as you should be too. So let's get right to it. First out of the gate, year to date, we've had a rally across the board from the Dow, the NASDAQ, and the S&P. We're going to look at the S&P and see if this has legs or where are we in terms of the rally that we've seen year to date on the markets, as well as a US dollar update, and then we're going to get into international and emerging markets. So let's jump right into it. This is brought to us by Strategis, and independent third-party research firm that we use, and they're excellent at what they do. And this is a chart of the S&P 500, and as you can see, I'll walk us through this right now. The S&P 500 has had a series of tops going back over the last 12 months or so. And you get to see a rally that we saw since October right here, all the way through still to where we are today. So there's no evidence of pronounced selling pressure right now, and that's a good thing. And the distribution of the market has paused, though, in terms of what we're seeing is year to date is a lower quality bounce. So think companies that were beaten up the worst year to date last year are the best performers out of the gate year to date, while high quality is still up respectively, but not as much in terms of this lower quality rally. Overall markets are up, and we want to see that distribution continue. So when higher quality starts to sort of get a bid here, that's what we want to see. So as positive evidence that this rally can continue, and it's making a positive formation on the charts. So we're going to pay attention to that and keep an eye on that, but that's where we are right now in the S&P. And again, as I said before, what's happening is this is two charts comparison of January of 2021 and performance quartile of the 2000 calendar return. Essentially, in this left-hand side right here, I'll put this in green here, the 2000's worst performing stocks in January were the best performers. Going back to where we are today in January 2023, as we all know, this looks very similar. If you keep in mind, 2020 or 2001 was a challenging year. Obviously, we had 9/11 in the back end of that year as well. So, but we do see some positive, constructive signs for this market rally to continue. We have to have all the other quartiles actually kick into high gear, and that would be the higher quality stuff. Next, we have the dollar plans. The U.S. dollar has had some major support zone between the 100 and the 103 level. That's right here. We can see this right here. So the dollar has support. It's come down in the last 3-4 months from the higher highs of last year. Dollar was extremely strong, and really the reason why that is that the Federal Reserve's policy of raising the interest rates here also supports the U.S. dollar. So what is the dollar telling us? Will the Federal Reserve at some point in time, maybe this year, later this year, slow down raising interest rates, or even maybe 2024 accommodate by pulling back sort of all the interest rate increases that they've put into place both this year and last year. The dollar is going to be one of those tall telling signs to sort of indicate what the Federal Reserve will be doing on a go-forward basis. But if the dollar happens to continue this decline and doesn't rebound for a period of time, you could see the move towards international. We saw international bounce year to date. We also saw emerging markets bounce year to date. And that's one of the trades where when the dollar comes down, international asset allocation for international sectors in that part of the market looks very favorable. So we are bullish on international. There are some signs that a lot of other countries outside ex-US are seeing some strength. Last year we saw Europe fall into a recessionary period of time, but they seem to be pulling out of it right now. And what's really the growth that we're seeing all around the globe is coming from China. So they've pivoted from their zero COVID policy. You've got now last month and a half of 1.3 billion people, second largest economy in the world, starting to reopen. So you're seeing the shift from goods to services, and that's also going to be a global growth factor. Another reason why international looks appealing here. Even though we don't invest directly with China or Chinese companies, the knock-on effect of that, again, reopening 1.3 billion consumption is going to pull through all the other surrounding countries, if you will. So there are countries that are in the even not so developed markets like the emerging markets will benefit from the global growth story as we're seeing this play out with China. So that's the story right now. Those are the 3 topics of today. Thanks for watching. Don't forget to like and subscribe. And this is what we're paying attention to, so you should be too. Thanks. Have a good day.